Okay, so today we're going to talk about something a little different. Today we're going to talk about the Bank Term Funding Program, what it is, how it's helped us, but how it could also hurt our economy in the near future. So do you remember all the bank collapses that we saw in 2023? We saw three very large banks collapse in March and in May in 2023. Signature Bank, Silicon Valley Bank, and First Republic all collapsed. And when that happened, that drove Treasury prices down, essentially lowering interest rates in March and May of last year. Then, all of a sudden, all these bank collapses and this turmoil completely ended, and we haven't heard from them over the course of the past year. However, this is starting to come back. Over the course of the past 3 months, in just January to March, over the course of the past 2 months, in just January and February, New York Bank has dropped by over 60% in its stock value in just these first 40 days, which is quite a bit. Why? Well, possibly because this program that came out last year from the Fed is ending. So let's dig into what this program is. So the BTFP was a program launched by the Fed to provide banks and credit unions access to short-term liquidity to help, protect the banks. Essentially, this was a short-term bailout for banks over the course of the past year. And let's explain why this happened. So again, this could be a long video, but stay tuned. I promise it's worth it. So last year we talked about this several times. When Treasury prices went up, or when the Fed hiked interest rates and Treasury prices went up drastically, this caused a lot of issues in the banking sector. Let me explain. If I loan somebody $100 and I expect to get paid 2 to 3% interest, well, then I'm going to get that $100 plus $2 to $3 on top because that's the interest being paid. And that's what happens when people buy U.S. Treasuries. They're buying, and now they're essentially guaranteed that 2-3% return over the course of a duration, over the course of that bond period. And essentially it's free money. Why? Because it is backed by the U.S. government, the good faith and credit of the U.S. government. So it's essentially free cash. However, Treasury prices, which were driven to significant lows during the pandemic, and then all of a sudden started rising drastically when the Fed started hiking rates, caused a banking problem. Because what happened was, all of these banks, they take their money, right, and then they load up and they buy things because they have to make money somehow too. What they did is they bought a lot of treasuries, and let's just say it's paying back that 2%. Well, then treasury prices skyrocketed up to 5%. But when you lock in that interest rate, you're locking it in for that duration, that period of time. So then a year from now, if treasury prices are 5%, and now somebody buys that 10-year treasury, and now it's paying back 5%, well, that's a better investment. And it's a great thing to have that. So what happened to that person who bought the treasury prices a year ago? Well, essentially, it becomes valued at significantly less, because why would anyone want to buy anything when it's paying back 2% when today it's paying back 3%? Now, normally this isn't an issue. However, when you have a liquidity crunch, which we had last year, when a lot of consumers, people who have money in the banks, want to go withdraw their money, well, then the bank has to give them their money. They just can't not do that. Well, if the bank ties up all that cash that was deposited into their accounts in treasuries, well, then they have to sell off. So again, it's not a problem. It's like, okay, hey, I'll wait the 5 years, I'll wait the 10 years, I'll get my money back plus a little bit of interest. Yes, I'm not getting that 5% interest that some people are getting, but I'll still get my money back. But then everyone wants their money back. The banks are holding all these deposits, and they want to take all that cash. Well, then they have to sell at a realized loss. So essentially, you have to sell those treasuries that you locked in for 6 months, 5 years, 10 years. You have to sell them at a massive discount because you need to pay back the people who want their money. Because somebody else isn't just going to go buy that 2%, 3% appreciation when 5% is available. So then you're going to have to sell those at a discount. So we saw a lot of unrealized losses, or losses in the banking sector. So what the Fed did is they came in, they protected a lot of these banks. And they said, hey, here's access to free liquidity at par pricing. Meaning, essentially, oh hey, as I mentioned, if you bought those treasuries a year ago, they're now valued at significantly less. The Fed said, hey, we're not going to value it at anything less for a full year's time frame. You kind of get a year to make up for these unrealized losses. So you saw a lot of banks come in, tap into this free liquidity, but that is ending. It's officially ending on March 11th. And it doesn't mean on March 11th we're going to have some type of massive collapse in, the mid-sized banking, because essentially they have a full year. So if somebody who's tapping in today, they get a full year to figure this out. And we don't know if the Fed's going to do something again to kind of solve this. But what we're doing is we kind of kick the can down the road. A year ago, we were seeing these bank collapses. Haven't heard anything over the course of the past year. Now we're seeing the stock prices of mid to medium-sized banks start to come down. And is this the reason why? It is likely. Can't guarantee that, right? But we're seeing that the fear and the uncertainty, the doubt from all these banks is now starting to come back because the access to that free liquidity is going away. So with all of that information, what does that mean? What does that do for interest rates? Ultimately, we don't know, right? We just know when there's fear and there's turmoil, usually it causes the Fed to want to pivot. As of now, again, the Fed meets, next meeting is until March 20th, so 50 days away. And as of last week, with a strong jobs report, with Jerome Powell going on 60 Minutes and pretty much saying that they don't really see a rate cut in the next meeting, maybe even the farther, it's looking like, hey, rate cuts are looking towards May, June, July, and that's when interest rates should start to come down. But with this crisis, will it cause rates to come down sooner? And again, I don't know. All I know is that when we had these crises last year, the Fed usually has to do something because they don't want the banks to continue to have all of these losses. They need to be able to refinance that debt at a little bit less of a loss instead of like a 550 benchmark, maybe even a little bit lower. So just stay tuned. It's a very important thing to watch. And again, nothing is going to happen on March 11th. It's just an important factor to watch. If banking collapses start to come back in summer, we know the reason why, right? It's because this program just completely ended, and that could lead to lower treasury prices because it could ultimately lead to a quicker Fed pivot and maybe even a greater Fed pivot in the summer, maybe Q2, Q3 months. So stay tuned, and we'll look out for it.